Hey everyone, welcome back to the Magic Market, where we break down the biggest names in the stock market. Today, we're putting two entertainment giants head-to-head, Disney and Netflix. These two companies have dominated the streaming wars, but which stock is the better investment right now? We'll compare key financials, growth strategies, and risks to help you decide. Let's get into it. Disney, NYSE, DS, and Netflix, NASDAQ, NFLX, have been at the center of the entertainment industry's transformation. While Netflix pioneered the streaming revolution, Disney has leveraged its legendary brand and vast content library to compete aggressively. Both companies have strengths and challenges, but they operate with different business models. Disney is a diversified entertainment conglomerate, earning revenue from theme parks, merchandise, and box office hits alongside streaming. Netflix, on the other hand, is a pure-play streaming company, fully focused on growing its subscriber base and producing original content. So, which stock is the better buy? To find out, we'll analyze 5 key areas: revenue and profitability, streaming growth and competition, content strategy and brand power, financial health and valuation, and long-term risks and outlook. Disney's revenue and profitability. Disney reported $88.9 billion in revenue in its most recent fiscal year, benefiting from multiple revenue streams, including theme parks, merchandise, and box office hits. However, Disney Plus is still unprofitable, and the company is investing heavily in content and technology to turn it around. Disney's operating income stood at $11.5 billion, but higher costs in streaming and content production have pressured margins. Theme parks remain Disney's most profitable segment, helping offset losses from streaming. Netflix's revenue and profitability. Netflix, as a pure-play streaming service, generated $38 billion in revenue, significantly lower than Disney's total revenue. However, Netflix has a key advantage: profitability. The company reported an operating income of $6.9 billion, and while it still spends heavily on content, it consistently delivers higher margins than Disney's streaming segment. Who wins? If we're looking at overall revenue, Disney is the clear winner. However, when it comes to profitability within the streaming business, Netflix is ahead. Investors looking for a more stable revenue mix may prefer Disney, while those prioritizing strong streaming margins may favor Netflix. The battle for streaming dominance is at the heart of this comparison. Both companies are investing billions into content to attract and retain subscribers. Disney's streaming performance. Disney Plus has grown rapidly since its 2019 launch, reaching 146 million subscribers across its platforms, including Hulu and ESPN+. However, subscriber growth has slowed recently, and Disney is now shifting its focus toward profitability by cutting costs and introducing an ad-supported tier. One of Disney's biggest challenges is subscriber churn. As prices increase, some users cancel their subscriptions. The company is also heavily reliant on international markets, where lower price plans mean lower average revenue per user. Netflix's streaming performance. Netflix, with over 247 million subscribers, remains the industry leader. Unlike Disney Plus, Netflix is already profitable and continues to increase its average revenue per user through strategic price hikes and its own ad-supported tier. Netflix has also cracked down on password sharing, which has led to a boost in paid subscribers. The company's long-standing presence in streaming gives it an edge in retention and monetization strategies. Who wins? Netflix currently leads in the streaming space with more subscribers and a profitable business model. However, Disney has the advantage of multiple revenue streams, which could help support long-term growth in streaming. Disney's content advantage. Disney owns some of the most valuable intellectual property in entertainment, including Marvel, Star Wars, Pixar, and Disney Animation. These franchises drive not only streaming engagement but also box office revenue and merchandise sales. One of Disney's biggest strengths is its ability to monetize content beyond streaming, something Netflix lacks. A hit Disney movie can generate billions across parks, toys, and theatrical releases. Netflix's content strategy. Netflix doesn't have a deep catalog of legacy franchises like Disney, but it has mastered the art of producing binge-worthy originals. Hits like Stranger Things, Squid Game, and The Witcher have proven that Netflix can create global franchises. However, Netflix faces more pressure to continuously produce new content, whereas Disney can rely on established intellectual property to drive long-term engagement. Who wins? Disney has the stronger brand and more monetizable intellectual property, but Netflix's data-driven content strategy has helped it dominate streaming. Disney's financial position. Disney carries more debt than Netflix, with over $45 billion in total debt, largely due to its acquisition of Fox and investments in streaming. However, Disney also generates strong free cash flow from its parks and media businesses, helping fund its growth. Disney's price-to-earnings ratio is lower than Netflix's, meaning it could be a better value investment if it successfully turns around its streaming business. Netflix's financial position. Netflix has been more disciplined with spending in recent years, cutting back on content costs and improving profitability. It carries around $14 billion in debt, much lower than Disney's. Netflix trades at a higher valuation, meaning investors are paying a premium for its consistent streaming success. Who wins? For investors looking for a more undervalued stock with diversified revenue, Disney may be the better choice. But for those prioritizing financial discipline and profitable streaming, Netflix is a strong contender. Every stock has risks, so let's examine the challenges facing Disney and Netflix. Disney's risks: streaming profitability. Disney Plus is still unprofitable and may take years to turn a consistent profit. Cord-cutting impact. Disney still relies on traditional TV revenue, which is in decline. High debt load. The company's debt could limit growth opportunities. Netflix's risks: content costs. Netflix must keep producing high-quality content to retain subscribers. Subscriber saturation growth in key markets like the US is slowing. Competition rivals like Disney Plus, Max, and Amazon Prime continue to challenge Netflix's dominance. Who wins? Both stocks have risks, but Disney's diversified business model provides more stability, while Netflix's streaming dominance makes it a strong growth stock. So, which stock is the better buy? Choose Disney if you want diversification, strong brand power, and long-term stability. Choose Netflix if you want a focused streaming leader with strong profitability and growth. Ultimately, both companies offer unique advantages depending on your investment style. Thanks for watching. Be sure to like and subscribe for more stock market insights. Let us know in the comments. Which stock do you think is the better buy, Disney or Netflix? See you next time on The Magic Market.